I keep hearing about stop-loss orders, but I'm not even sure what they actually do. Can you break it down simply?
Sure. A stop-loss is an automatic instruction to your broker to sell a stock if it drops to a price you choose. It caps your loss without you watching the screen all day.
So if I buy a stock at $100 and set a stop at $90, what exactly happens when it hits $90?
Your broker instantly turns that into a market sell order. You get out near $90, minus small slippage. Your max loss is roughly $10 per share, no matter how far it falls after.
But I've also heard about stop limit orders. Are those the same thing or something different?
Different. A stop limit triggers a limit order at your set price, not a market order. It guarantees the price but risks not selling if the market gaps down past your limit. Stop loss guarantees execution, not price.
Got it. So where should I actually place my stop loss? Is there a smart rule for picking that price?
Place it below a key support level, like a recent low or a moving average. Avoid putting it too tight, like 1% away, because normal price wiggles will knock you out early.
What about trailing stops? I see that term everywhere. How do those work in practice?
A trailing stop moves up automatically as your stock rises. Say you set a 10% trail. If your stock goes from $100 to $120, your stop rises to $108. It locks in profits while letting winners run.
That sounds great, but what's the biggest mistake beginners make with stop losses? I want to avoid that trap.
Setting the stop too close to the buy price. A 2% stop on a volatile stock will trigger on normal noise. You'll sell, then watch it rebound. Give your trade room to breathe.
So the stop distance actually affects how much I should buy? That's a new idea for me.
Exactly. If you risk 1% of your account per trade, and your stop is 5% below entry, you size your position so a 5% loss equals that 1%. Stop distance determines position size, not the other way around.
Can you give me a concrete example with numbers? That always helps me remember.
Sure. You have $10,000 and risk 1%, so $100 max loss. You buy a stock at $50 with a stop at $47.50, a 5% drop. Divide $100 by 5% of $50, which is $2.50. That gives you 40 shares, costing $2,000.
So if the stop gets hit, I lose exactly $100. That makes risk feel manageable. But what about gaps overnight or news spikes?
Good point. Stops don't protect against gaps. If a stock opens 20% lower, your stop sells at that lower price. That's why you size positions so a worst-case gap doesn't wreck your account.
Final question, what's your one actionable tip for a beginner investor setting their first stop loss today?
Start with a 10% stop below your entry for most stocks. Use a trailing stop once you're up 5% or more. And always calculate your position size based on that stop distance before you buy.